Hi, I'm Jerry Slusowitz. Welcome to one of my Your Money Talks video series. We try to update you once in a while when we see different changes in the market or different things that we need to make you aware of. Today, again, is Thursday, the 27th of March. What we're seeing is a lot of churning going on in the market. The churning means we kind of go up a couple of days, down a couple of days, up a couple of days, down a couple of days. We haven't seen any movement in the market since March 13th. We're pretty much right where we were. As a matter of fact, on the year, there's not a whole lot of gain. The Dow's down about 2%. The NASDAQ and the S&P 500 are basically flat, and here we are only a couple of days left to do in the first quarter. So it's not been a great start. Now, granted, we're right near the highs. That's always a good thing to be near the highs, better than being on a downside. But I see a bad formation forming. And that formation is one where the last several days, we're starting the day very positive, very high, up 60, 70, 80, 90 points, and then we're closing at the end of the day either flat or negative. Yesterday, the 26th on Wednesday, was a perfect example. We were up 99 points in the first half hour of trading, and we closed down 99 points. That doesn't mean back to zero. That means negative 99. That's a 198-point swing between open to close. We also closed yesterday right at the low of the day. I hate when I see markets close at the low of the day. It's like the sellers ran out of time. They were going to score more points, but they couldn't score more points because time ran out. That's why we saw a little bit follow through today. We're down a little bit here at this taping. But that's something that I really don't like to see. In addition, the biotech sector has really gotten hammered. The biotech sector, there's really not a lot of earnings in that sector. A lot of these companies are just more R&D, research and development. And they really depend on speculative money to come in. And they bid those valuations up sometimes extremely high. And that's what we saw. We saw the biotechs do really well over the last 2 years. I mean, extremely well. But here we are seeing biotech sell off around 13% just this month alone. And really, a lot of it's in the last 6 trading days. Biotech, one of the leading sectors last year and into this year, not a good sign when your leaders are starting to get hit. Companies like Priceline, PCLN down about 20%, Tesla down double digits as well. Some of your momentum leading stocks also down. The reason I mentioned biotechs, though, is the last 2 quantitative easing, biotech led the way down. It's kind of the canary in the coal mine in terms of when the market might turn south. That speculative money is leaving the market, kind of going into safety. We've seen the quantitative easing go from 85 billion 3 months ago to 55 billion now. Next month in April, we expect it to be cut in 45 billion, almost in half from where we were in December. That's the stimulus program. Yet with all this stimulus, all we saw today was a 2.63% GDP final number for the fourth quarter, and they're expecting this first quarter, as we're almost to a close, to be less than 2%. All that stimulus globally is not helping the stock market a whole lot. Another indicator that I'm looking at is the 30-year Treasury mark. The 30-year Treasury bonds are now at 3.54%. That's a 10-month low. It's another sign that money's rushing into safety because as they bid the prices higher, interest rates go lower. We're seeing a 10-month low in the 30-year Treasury. TLT, Tom Larry Tom, is the long Treasury exchange-traded fund. That appears to be breaking up and out of an 8-month base. Looks pretty good with a buy stop or a sell stop at 101. So overall, the market's gone nowhere. As I mentioned, Dow down, S&P, NASDAQ flat. A lot of things are out there. The market valuation, the CAPE, the cyclically adjusted price to earnings ratio by Case Shiller, by Robert Shiller, Yale professor, around 25, 53% overvalued to historical normals. The bull market is also in its 60th month for the last 120 years. The average bull market cycle is 53 months. We're a little long in the tooth. We're in the second year of a presidential cycle. The last 80 years, the average decline in the second year of a presidential term is 21%. Not saying it's going to happen, but there's reasons for us to be cautious here at Pacific Financial Planners. I strongly recommend you get that free no-obligation portfolio review. Call my office, 1-800-449-9501. Let alone all the main news out there about what's going on in Russia and China's economy slowing down. A lot of reasons to get a second no-obligation look at your portfolio. 1-800-449-9501. Follow me on Twitter as well. It's at PFP Invest. The PFP is in Pacific Financial Planners. At PFP Invest. Go to Facebook, like us there. Follow me on LinkedIn. Go to our website, www.yourmoneytalks.com, and call today. It is very important as we head in to the summer months, the spring to summer months, when the market gets rocky historically, especially given the conditions we have today.